Trading on margin can be tricky because it involves high risks, and you may lose more than the funds you actually have available in your account. Investors often borrow money to buy stocks, bonds, and commodities or other investments. Borrowing money for investments works well only when the returns are greater than the borrowing costs. When the return is less than the borrowing costs, you must repay both the amount that you borrowed and interest, even if you lost money on the investment. There are always dangers when borrowing money to buy investments. Trading on margin requires you borrow from your broker. Using margin brings a cost, and this cost is the interest that you'll pay on the amount that you borrow until it's repaid. Margin accounts require brokerage approval. A line of credit to your account is secured by collateral, and this collateral is called the margin requirement. The margin requirement consists of cash and the other investments that have to be deposited in the margin account. The margin requirement is based on the amount of buying power that it creates for you. The ability to make large investments with a small amount of your own cash is called leverage. Traders use leverage to magnify the return on their investments. Leverage magnifies both the profits and the losses. A margin account with a $2,000 balance could buy 100 shares of hypothetical stock JMF at $40. The cost would equal $4,000. $2,000 of your cash, which is the minimum margin deposit in your account, plus $2,000 of margin. Using only the cash in your account would let you only buy 50 shares of JMF at $40. That cost would be $2,000. So if the share price moved up to 50, the margin account would yield a profit of $1,000 or a 50% return. The cash account would yield a $500 profit or a 25% return. If the shares drop below $40, a margin call would be issued. A margin call requires a deposit of cash or securities from outside of your account or by selling some of the securities in your account. If the shares continue to decline, your margin requirement might be raised by your broker. So if you fail to satisfy the margin call, the hypothetical stock JMF stock position would need to be liquidated. Sometimes that deficiency is not met sufficiently by liquidation. The biggest risk in trading on margin is if the stock price turns against you. You could end up with losing your collateral and owing your broker money. There are many situations when margin can be used in a safe manner, but risk must be carefully managed as losses could spiral out of control and cost you more than your investment.